everybody. You are very welcome today. For those of you that don't know me, my name is Sarah Murphy and I am the current chair of the Chartered Accountants Ireland Leinster Society. So following on from our very successful CPD conference last month, this is the first of our expert series. These are monthly lunchtime sessions that we run around various topics where we get subject matter experts to talk to us about things to educate us on what's going on in the world. So today, following on from the budget last week, I'm joined by my PwC colleagues, Colm O'Callaghan and Kerry O'Hanlon, to take us through some of the changes that were announced in the budget, covering all sectors, both personal and business. It'd be a whistle-stop tour. They will have time afterwards for Q&A. So if you do have any questions, if you can just pop them into the Q&A box there, and we'll make sure that we pick them up and hopefully address your questions. So over to you. I think Colm is going to take the first section and then on to Kerry. So I will hand over to you now.
Perfect. Thanks, Sarah. We might just move on to the next slide. Great. Good afternoon, everyone, and thank you for joining us today. Yeah, look, we probably meet a week after budget and literally on the eve of Finance Bill 2026. So I'm sure many of you attending this webinar today are having many conversations with clients across the board in relation to what is happening at the moment. However, today we're specifically going to focus a little bit backwards on what was announced in the budget last week. And I appreciate a lot of people will have covered a lot of ground already via media and what they're hearing. But I think it's worth doing a little bit of a deep dive as we whistle stop through it today on a couple of key points that I think are going to be of relevance. So just set the scene for just 2 seconds before we delve into some of the measures. Budget 2026 was unveiled by Ministers Donoghue and Chambers last week and did mark a very clear shift in terms of moving away from expansive one-off measures of recent years and into kind of more, I suppose, best way of putting it, targeted or fiscally sustainable strategy. So they had a total budget package of about 9.4 billion, of which 8.1 billion of that was in terms of spending, with what we call on the right-hand side there, cuts of about 14%, but about 1.3 billion in terms of tax measures, which is usually indicated in terms of reducing tax in some shape or form or using tax policy to incentivize. As the minister said himself on the day, that's Minister Donoghue, this is a budget that protects jobs and protects growth in an uncertain economy. And I think the budget did arrive, and currently we're all living in a world whereby there is global uncertainty. There's rising living costs, there's domestic challenges in housing, healthcare, climate action, but it also reflects, I suppose, a bit of confidence in some of the fundamentals where we are projecting a fairly sizable surplus of about 5 billion and continued full employment in the economy. So things are going very strong. And I think we just need to kind of bear that in mind sometimes when we listen and look at things in a whole. Today, we're going to explore some of the kind of key priorities and measures for budget 2026, ranging from the 5 billion housing investment to the new enhanced supports for enterprise and innovation, R&D regimes, and so on. We'll also examine implications for businesses, households, broader economy. But I suppose, before we get into those, I probably wanted to kind of stand back and even go further back, not too far back, but just a few weeks back. What were businesses and a lot of our clients clamoring for in relation to what they'd hoped to have seen? And did we see some of that? So certainly they were looking around maintaining Ireland's competitiveness. There's been a big kind of sound out there of late amongst the business community that we're slipping a little bit, particularly in terms of the global shift in policies, whether it's tariffs, whether it's rising costs of doing business. All of these things are impacting our clients, our customers, and businesses more broadly. So being brave and bold around reducing the cost of doing business is going to be key. And maybe we'll see some of that in the finance bill, hopefully. But I know certainly the government have been talking quite strongly about reducing that cost, cutting red tape, the inverted red tape, and hopefully where possible, kind of reducing unnecessary regulation, right? I think that's going to be key. Not getting rid of regulation, but just reducing unnecessary excessive regulation that's hindering. Aligned to this would be something close to my heart, probably simplifying the tax code. So there's been a big push certainly around trying to kind of see, is there a way of simplifying the tax code for particularly SMEs and smaller businesses, many of whom are literally simply drowning in the paperwork needed. And I'm sure all of you are seeing that as well with your clients and your customers. Like a statistic that jumps out for me is that in 2024, the CT, or the corporate tax return, was 66 pages. Only about 12 or 13 years ago, it was about 22 pages. It's just simply becoming unsustainable, right? Enhancing the competitiveness, R&D regime improvements, participation regime improvements. It was very good that came in last year, but it's excessively complex. So will we, or did we see anything on that? We'll touch on that in a minute. Helping the infrastructure challenge, which I talked about, was key to a lot of businesses coming into this, and using tax policy to support that. So did they do something on that? And that was just before businesses in certain sectors even called for the well-announced, VAT reduction for hospitality, all the things that meet and are caught in the media. So what did businesses say more broadly? I suppose generally, I think the business sector received the budget last week positively. Certainly in tech, innovation, and property development, we saw a lot of measures aimed at supporting those sectors, and that's welcome. The R&D tax credit regime increased to 35%. We'll come on all to these in a little bit of detail, but that's seen as being pro-initiative, or pro-innovation. Sorry, apologies. Entrepreneur relief, again, something very close to what I've been shouting about for many, many years. For many of my clients, saw some movement, moving up to 1.5 million. There was housing incentives, so tax was being used to incentivize house building, and particularly apartment building. And then there was much more funding being made available, whether it was through Enterprise Ireland or other supports and initiatives. However, on the flip side, and Kerry will touch on some of this, for individuals, the story probably wasn't the same. So, probably a little bit more cautiously accepted, somewhat critical, particularly because there was no broad cost of living measures announced. So a lot of the previous supports we would have seen announced for the last few years to help with the cost of living, they just simply weren't there. And where cost of living increases did arise in terms of welfare increases, they probably weren't matched, or probably weren't in line with what we're seeing in inflation. Housing measures, again, certain sectors are criticizing some of the measures announced simply because they dealt with kind of developers rather than necessarily dealing with perhaps the potential purchaser or the first-time buyer. So look, the government is damned if they do and they're damned if they don't. We all know that. But I think just generally it was very much geared towards business and business measures. I suppose if we just go on to the next slide for a second. Sorry, whoever's, yeah, brilliant, thank you. I just wanted to put this up really, really quickly because it's something, we hear time and time again, particularly as the government frames the budget and they talk about, what's underpinning the exchequer finances. And as you can see from the kind of pie chart up there, it's broadly a third VAT, a third corporate tax, and a third of income tax. But we're all very, very minded of the kind of fragility or perceived fragility of corporation tax and how much that is a windfall, excluding even Apple, but just are we over reliant? And in fairness, Minister Donoghue made a big impact on that and made big comments on that during the budget speech last week. He did acknowledge that the record receipts are continue to be expected into next year, but he is concerned about the volatility and concentration of that. And he is saying that there should be no assumptions of continuity. So they are planning towards that red section of corporation tax not being as big as it possibly maybe could be. Hence, there was a lot of investment being made into long-term funds that the government had been effectively saving for that day in due course. And a clear acknowledgement by the government that there is a dependency on that at present and that they need to effectively reduce that dependency in order to become more sustainable with the exchequer long run. So that was, I suppose, just trying to give a little bit of context for people on the call today about some of the kind of framing of the budget by the two ministers in question. And with that, I probably will just hand you over now initially to talk through some of the employment tax and personal measures to Kerry, and I'll come back later then again.
Perfect, thanks, Colm. So I suppose Budget 2026, as Colm alluded to, didn't feature a broad range of income tax changes. So you'll see on screen there, there was no changes to the income tax rates or credits. So the standard rate cutoff point for income tax will remain the same, and the standard credits that are in place for 2025 will also remain the same for 2026. There was a modest increase in the USC threshold for the second USC rate, so that's the 2% rate, which increased to 28,700, and that the idea there was that that would ensure that minimum wage workers wouldn't be paying higher rates of USC. But then there's also increase in social security costs, and this is something that was signalled to us previously. So there is expected that there will be PRSI increases from 2024 all the way to 2028, and that's already has taken effect. So from 1 October 2025, employee PRSI has gone up from 4.1% to 4.2%, and from or employers PRSI has gone up from 11.15% to 11.25%. So to summarise from an income tax rates perspective, well, there is I suppose a nominal decrease in the amount of USC a taxpayer will have to pay. It will ultimately be set off by the increases in PRSI. With all the, I suppose, speculation prior to budget day and the media coverage, it was no real surprise that there wasn't much of an income tax package. But I suppose it is important to be aware of the impact of that. It is unusual. This is the first time since 2021 that there hasn't been any changes in the income tax bands. And historically, I suppose what we see with budgets is that they usually help offset, I suppose, what we would call fiscal drag. But what we can expect next year is that more people will enter into the tax net, more people will pay tax of 40%, and the tax credits that we have, because they're not changing, I suppose, will lose their value in a real sense. So if we just move on to the next slide, I suppose just to give an example of this in practice. So on the slide here, we have an example for a single individual who is a tenant, so who's renting, and assuming they're, let's say, earning 50,000 in 2025 and then get a 4% increase or a pay rise in 2026. What we see here is even with that pay rise for inflation, once you consider the additional tax costs, so the additional PRSI costs, and then things like the removal of the energy credits, which aren't being extended for 2026, and once then you also consider inflation, that individual can actually expect to have a lower net pay, and that is something we are seeing across the board. If I just move on then to kind of cover off on some other key personal tax measures. So local property tax, I suppose, while it wasn't mentioned on budget day or in the budget speech, it is relevant. So 1st of November 2025 is going to be the re-evaluation date for LPT. Last evaluations were in 2021. So obviously there's been significant increases in home values since then. So it will be quite important. There's some changes in widening of the bands, so we can expect some of the increase in home values to be offset by those measures, but it's still forecast that over the next few years that anyone who has a home valued below 1.2 million can still expect to have an increase of about 5 to 6% on the LPT that they're paying. And for anyone who has a home valued above 1.2 million, it could be as high as a 14% increase. So there really are, I suppose, significant costs coming in across on the horizons for homeowners. There are some positive developments, though, I suppose, in a welcome move for investors. There's a decrease in the tax rate from 41% to 38% on funds. So that includes like regulated Irish funds, offshore funds, and then certain foreign life assurance policies. We will also see, I suppose, a maintaining of the 9% VAT rate on gas and electricity bills, which is, again, another welcome measure considering that we won't have the value of the tax credits next year. We just wanted to include a quick update on pensions as well. So the state pension has increased by €10 a week, which is roughly a 3.5% increase. It will provide, I suppose, an additional level of relief for individuals, but it's still, the increase is still below the expected rate of inflation for next year. We've probably all heard from the media that there's a strain on public finances, particularly with regard to funding the social insurance fund. And that's largely due to, I suppose, the ageing population that we have in Ireland, which has been flagged as one of the fastest ageing populations in Europe. Currently, we have 5 taxpayers to fund 1 pension, but by 2050, it's expected that will reduce to two taxpayers, which obviously isn't sustainable in the long term. So I suppose to combat that, the government are looking at introducing auto-enrolment. So what is auto-enrolment? I suppose it's an initiative that's being set up by the government to provide for broader pension coverage across Ireland. And it's set to commence from 1 January 2026. And how it will work is for any individuals who are between the ages of 23 to 60 who earn more than 20,000 will be in scope for auto-enrolment if they don't currently contribute to an occupational pension. So the idea is that those individuals will make a contribution of 1.5% on their gross earnings from 1 January, and that will then be matched by the employer with a 1.5% contribution as well. And then there will be a state contribution on top of that of 0.5%. They're the rates that are in place for 2026, but it is expected that over the next 10 years, contributions are set to rise up to 6% for employees and employers, and 2% for the state contribution. So overall, I suppose auto-enrolment is good. It's good news for employees who don't currently contribute to a private pension, but it is an additional cost for employers. So if we just look at this example here, so this is an example of the additional employer costs. I suppose if you had an employee who's on minimum wage who didn't have any previous pension funding, and you'll see in this scenario, if you look at the combination of the additional employer's pre-RSI costs plus the auto-enrolment employer contribution, you're looking at an increase of roughly 6% for that one individual in 2026 in terms of cost. So it is significant, or a significant cost for employers, and it's only going to increase considering that the auto-enrolment contributions are going up over the next 10 years. I suppose another thing just to mention here is that while auto-enrolment will also be another cost for employers, it will also have an impact on employees. So it doesn't work like an AVC would work, where you get income tax relief on contributions. It's a net contribution from the employee's pay, so it will have a direct impact on employees' net pay. Most employees are, happy to make that contribution in order to be able to contribute to a pension private fund. But you are starting to see some questions from employees around well, how can I actually opt out of the scheme? So some people are concerned about the net impact on their pay. So if we just move on then to a quick update on company cars. So this was probably one of the biggest updates from an employment tax perspective in the budget. A few measures brought in and extended. So for electric vehicles, there's an extension to the 5,000 relief for EVs for VRT, and that's extended to the 31st of December 2026. There's also going to be the introduction of new reduced BIC rates that are going to be known as an A1 BIC rate for any electric vehicles, ranging from 6% to 15%. As well as that, for all cars in category A to D, the universal or the temporary relief of 10,000 is going to be extended when calculating BIK on cars. It's going to be extended on a tapered basis, so it will continue to be 10,000 for 2026, going to 2,500 in 2028. And then also the higher mileage band is permanently reduced to 48,001. So it's been great to see these reliefs extended. They're very popular with both employers and employees. Just I suppose a final update then from me on employee tax reliefs. So there has been an extension to SARC relief. So I'm sure a lot of people will be aware with the relief, but it's Special Assignee Relief Programme. That's a relief that's available for people who move to Ireland with their employer. So a couple of changes to the relief. So the annual salary requirement has been increased from 100,000 to 125,000. But probably the biggest update is that the relief, which was due to expire at the end of this year, has been extended out to the 31st of December 2030, which is really positive to see, because it's really a key relief that we see for employers to attract talent into Ireland. So it really is great to see it extended. The government have also mentioned that there will be some admin simplifications around applying for the relief and around kind of employer returns. We're not yet sure what exactly they will be, but any kind of simplifications will definitely be welcomed. As well as that, the government have extended foreign earnings deduction relief for Irish employees who work abroad. It's available for certain locations, but they have also added the Philippines and Turkey to the list of locations where FED can apply, and the limit on the relief has increased from 35,000 to 50,000. We've also seen a potential, I suppose, extension of the KEEP scheme, which is a tax-efficient share option scheme that employers can introduce. And that is subject to a commencement order, but again, is very positive to see that it will be extended and made available until the end of 2028. So that's just a summary, I suppose, of some of the key updates from me. I think I'm passing back to Colin now just to give more of an update.
Great, thanks, Kerry. So just to touch initially on the whole area of housing and infrastructure and what was done in that context. I suppose just again a little bit of backdrop just at the start, right? Everyone's well aware of some of the infrastructure deficits we have, particularly in housing, and we're miles behind in addressing some of this. And there's probably two ways of kind of trying to fix that, from creating stock, which can be hard because just takes time, but also ensuring that stock does get delivered. So to the extent they can take friction out of the system on either side, either through tax policy or something more broadly, they were trying to kind of look to see could they address that. And I mean, I suppose currently, like I have a stat up there on the screen, which is talking about a viability deficit of about 100,000 on certain apartments. And that's really the difference between what a building cost and what its ultimate sale price is going to be, and how do they address that. So some things they have been working on as a government over the summer, particularly have been around, specifically in relation to design specification, changes around making it more affordable to build, but then also as well, reforming the judicial review process around planning. So again, that's trying to take what I would call grit out of the system that will hopefully speed up developments coming to market and coming to construction phase. But there was also a focus on this area of housing, specifically in the budget. And if I turn to the next slide for 2 seconds, there was probably a couple of areas that they really focused in on. And I'm not here today going to say, did they do enough? Did they not do enough? But just if I touch on some of the 4 key areas that they addressed or tried to tweak in terms of tax policy. Number 1 is the Living City Initiative, apologies. And that is really designed to try to bring derelict or rundown houses in certain urban areas back onto the market. And that was specifically dealing, it's been on the statute for a while, but it was dealing with certain areas in Dublin, Cork, Limerick, Galway, all the major kind of urban centres. And it was providing relief for properties that were built pre-1915 and bringing those back into housing stock. That's now been extended to certain other areas, including Sligo, Letterkenny, Drogheda, Donegal, Drogheda, Dundalk, and Athlone up above. But it's also been brought forward insofar as that now housing stock that were built pre-1975 might also be available to get into the Living City Initiative. So again, very, very targeted measure trying to bring older, more maybe rundown or derelict houses back into use, number 1. Number 2, below that, the derelict property tax has been announced. That's going to be a new tax coming in from 2027. It's going to be at a minimum rate of about 7%, and it's really designed to replace the derelict site levy, which has had its ups and downs, sometimes working, sometimes not. So the new tax will be phased in from 2027, and it's going to capture probably broader definition of sites overall. There's also a corporation tax exemption announced in the budget for cost rental income. And I must say, when I heard that being announced, I had to kind of look up what that meant myself. And just to give a little bit of brief overview what that is, that kind of covers buildings or development that ultimately is going to be rented, and that is designed the rent is only designed to kind of to cover the cost of the building itself. It excludes profit for the developer, and typically is about 25% below market rent. So what they've done in this is sort of further incentivize and say that any profit that does come from an initiative that meets that criteria will be exempt from corporation tax. I suppose the question I'd probably like to pose, and is there more to be seen in the finance bill tomorrow? You'd love to see some sort of initiative around, ensuring businesses maybe could, build properties, rent them to their employees, and maybe the rent could be taxable at 12.5 rather than 25. Plenty of things that could free up private capital to going into doing certain development, which might actually really, really kind of supercharge this along the way. Obviously, well announced, well published, the lower VAT rate on new apartments. So they've reduced the rate from 13.5 down to 9%. I have a couple of stats on the screen there, but broadly speaking, if you're saying your average apartment in Ireland is circa going to cost 250,000, that's about a 20,000 saving. It's not insignificant. The question is it enough? Will it ultimately see the light of day in terms of actually down to the first-time purchaser or the purchaser? We wait to see, but it's definitely the right measure and the right way of going at it. If I turn to the next slide, again, I'm going to probably go through some of these quite quickly because I'm conscious of time, but the rent tax credit was extended till 2028, so there's no change in the credit amount. It's still 1,000 for an individual, 2,000 for a couple. Mortgage interest relief, once again, I should say, extended for a further 2 years. It's constantly getting extended, but it's been extended for a further 2 years. Certain construction costs, there's been an enhanced deduction generated for some of those. So again, particularly in relation to development apartments, you can see they're really targeting trying to get apartments onto the market. Residential development stamp duty refund scheme has been further extended to 2030. I think what's most notable about that is that's a 5-year extension. So they're really trying to give a lot of runway to say, look, this is around for a long period of time. And just by way of brief overview, what is that? That is whereby you may have land that is not currently zoned residential, and a developer will buy that land, may pay up to 7% stamp duty, and provided they start construction and finish construction of development of residential within a certain time window, circa 36 months and another 36 months, so sort of 3-year window, you can get a reduction in your stamp duty that you paid of the 7% down to a much lower rate. So again, it is being used. It's designed to encourage to bring non-residential land banks into residential activity. Then there's retrofitting for deduction for landlords. That's been extended for a further period of time. And then there's been some technical amendments around residential zone land tax or ZLT. Perhaps a bit of a minority sport for those on the call today, but it is something that was, as I used the phrase, grit in the system, and it was causing difficulties, particularly around certain developers, whereby local housing authorities were asking them to develop on their behalf in a kind of pre-funded and forward-funded project. Next slide. In terms of private business measures then, just moving away from housing for a second and infrastructure to private business, there was numerous measures announced. And this was really going back to my opening comment about really trying to support businesses to be competitive and incentivize businesses. It was great to see that entrepreneurs relief has been increased. The lifetime gain limit has been increased from 1 million to 1.5. It's, a very, very welcome approach to incentivizing entrepreneurs, many of whom get no real recognition or reward for the hours and effort that they put into building a business. The 9% rate for the hospitality sector, I know the government got absolutely slated for this in terms of, some of the media commentary after the budget last week, but it really is needed in that sector whereby they are struggling with costs, and Kerry alluded to it. You can see the minimum wage increase, auto enrollment coming down the track. It's just cost after cost, and some of these businesses are really finding it unsustainable. In terms of stamp duty, there was a measure designed to, again, incentivize SMEs and certain Irish businesses, mid-cap and low-cap companies, to list effectively on the Irish Stock Exchange. And that's really a measure designed to protect the Irish Stock Exchange, because they're seeing an outflow of Irish listed businesses to other international stock exchanges. So it's really, really important that we have a viable and functioning stock exchange here. And this is a step to kind of incentivize businesses to list. And what it would mean is that there will be stamp duty exemption for those businesses that list on the stock exchange and meet that certain condition. Digital game credit, that has been extended to 31 December 2031. Again, real acknowledgement that this is kind of an area that Ireland is becoming well known for, and there's a lot of fledgling and sizable businesses now based here developing digital games and kind of gaming infrastructure. And what was really helpful was that the credit has been extended now to also allow for claims for kind of release or follow-on work. So anyone have children at home and there'll be phase 2 and new iterations and version X, Y, Z of a game. And really when those further developments are being generated, that now also possibly will qualify, provided the original game would have qualified in the development of the game. And then probably something that was noted in the budget speech, we might see a little bit more tomorrow in terms of the finance bill, was all around VAT modernization. And that's really the aim to modernize certainly B2B businesses to e-invoicing. This has been well signposted by Revenue and more broadly, but this is the first concrete step in terms of dates. So it's 2028 is when it's going to come in for B2B invoicing. And this is really all designed towards aligning towards the EU VAT in the digital age, or the VIDA you'll have heard about maybe, which is mandating that all EU invoicing is going to be, or sorry, all EU invoicing is going to have to be e-invoiced from 1 July 2030. So this is a path from here to 2030 now to do that. And that's going to be a lot of complexity for businesses to get their heads around it. So many of us on the call here will probably ultimately have to help businesses work through that. I touched on some of these. These were asks of businesses coming into the budget. And I think, in fairness, it was great to see the government listen to some of this. So the participation exemption came in last year, and that's around exempting tax on dividends from overseas entities. Very, very important for multinationals or for Irish businesses that have overseas operations. And it's really to bring us in line with many of our competitors in other jurisdictions. Unfortunately, when we brought it in, we probably brought it in too complex, put it simply, and probably not broad enough to compete with the likes of the UK and other jurisdictions where we're fighting for investment. So it's great to see that they are going to make simplification measures to it and also extend the geographic scope of the participation exemption. And we'll see more of that tomorrow again in the finance bill. There was an action plan being announced to say that they're going to look at the interest regime in Ireland. Anyone who advises companies in terms of interest deductibility will know how complex it is, from just straight up Section 81, normal trading deduction, all the way to Section 247, not to mention thin cap, et cetera, et cetera. It's becoming very, very complex, very hard to advise businesses and for businesses to understand what they can claim. And hopefully simplification in that will be well welcomed. There's a consultation also announced in the budget in relation to the broader area of withholding tax. And again, that's to be launched soon. So keep an eye out for that and where possible feed in, I would say. Capital allowances for intangible property. Again, there's amendments regarding the use of balancing allowances and the disposal of intellectual property. And again, very welcome measures. Particularly, these are all aimed with trying to make us competitive relative to other international locations, particularly for mobile businesses and businesses looking to put further investment in the country. And with that, it probably goes to their headline one, which they announced during the budget, which is really, really targeted and incremental improvements to the R&D tax credit regime. So what were they? Well, number one, they increased the tax credit rate from 30% to 35%. They also importantly increased the threshold for the first year cash refunds from 75,000 to 87,500. And that's hugely important for businesses, maybe some of the smaller businesses, as they, rely on the cash refund that is being received from the R&D claim. So that has been increased by, as you can see, nearly 12,500. So very sizable. There's going to be a compass announced in the coming weeks to consider, targeted changes to align it with better, kind of more industry practice. And there's going to be a focus on amending or restructuring what is the definition around outsourcing. And again, I think there's also going to be expanded definitions of what is qualifying R&D expenditure. And I think what we might see there is something around the lines of, particularly developments in AI and, high value end technology, where Ireland wants to be seen at the forefront of, and will they extend it out to some of that? I think my last slide, just to touch on briefly, because we haven't done so far, very, very briefly, in relation to kind of with a lens on climate action, although there wasn't much done from a green perspective, they did extend out the capital allowances, the accelerated capital allowances on energy efficient equipment out to 30 December 2030. That had a sunset clause that was sunsetting at the end of this year. That's been extended out for 5 years, which is good to see. And then they also exempted micro generation and extended that out as well, up to 2028, because many house owners and so on have put solar panels on their roof, and the little bit that they get from selling back into the grid would have been subject to possibly being taxable. So again, exempting that is very welcome again for another period of time. If I sum up, because I'm very kind of conscious of time and we want to leave some time for questions and answers, I think, for us, certainly looking at it for tax practitioners as a whole, I think it was a positive but very measured budget. It wasn't a giveaway on the income tax side, as Kerry alluded to. The question, I suppose, will be, it is the first budget of kind of a 5-year government term. So is there more to come? Because clearly they did have certain things in relation to what they would do on USC, what they do on, helping the squeezed middle. That was clearly in their manifesto coming in as a government. So they probably will have to touch on some of those in future years, but they certainly didn't go after it this year, probably to do with trying to kind of incentivize and improve the efficiency of business. There's definitely wins in R&D in the 9% for the hospitality sector. But I suppose, as I said, something close to a lot of businesses' hearts is, is there real measures in relation to driving down the cost of doing business or simplifying the position for many SMEs? There hasn't really been much in that front. And unfortunately, unless we see something tomorrow, I think that's something they're going to have to work on over the next few months. And I think businesses are going to get louder and louder shouting about that, because that's certainly what I'm hearing. But look, the outlook is positive. And I think tomorrow we'll see more. And it's really a good time for all of us as practitioners, as accountants, to be talking to our clients and staying close to them, because it's definitely a time of change and complexity. So, Sarah, I'll hand it back to you.
Thank you very much. Very comprehensive tour through what happened last week. Made a lot of it very much more understandable for me. So thank you. And I'm sure also for the people on the line. We have a few questions that have come through separately and through the Q&A. So if you do have any, please do put them up. But I will start. Colin, you mentioned around stamp duty and measures being put in place to support our stock exchange and protect that for Irish businesses, but I guess some of us had hoped, and there had been discussion around looking for retail investors and the deemed disposal rule, and that might be addressed. What's the situation with that now going forward?
It hasn't been addressed so far, Sarah. So I think we're going to have to wait to the budget, to the finance bill to see will they touch on any of that. They did, as I think Kerry alluded to, note that they are looking at, the kind of the CGT or the tax rate from 41 down to 38, I think it is, in relation to some investments. But certainly the 8-year deemed rule or deemed disposal rule has not yet been looked at. But again, it is on their radar, and hopefully they will address it soon.
Thank you. Another question around, has anything come through in relation to inheritance tax?
No, again, unfortunately, we'd all love that, but no, it didn't. There was no indexation of bands in relation to CAT. There was no further improvements in terms of some of the reliefs that many businesses and business owners would like to see, such as business property relief or retirement relief. There hasn't been enhancements in that front, unfortunately. Last year, you will recall, or people might recall, that they increased some of the age thresholds for retirement relief up to 70 years of age from 66. And they also extended the quantum that can be passed on to families at that stage, but not this year. They haven't touched it, unfortunately.
Okay, probably one for Kerry here, actually. As well as both of you mentioned, it was more budget focused on business rather than personal tax. And I guess given that there has been a little disappointment out there from a personal tax point of view, what can people individually do to make sure that they are protecting themselves, I suppose, in terms of this budget and going forward?
Yeah, look, I suppose there hasn't been much in terms of changes for taxpayers in 2026, but there has been extension of some of those key reliefs, especially around the tax credit for renters and the mortgage interest relief that the column had mentioned. I had read during the week that I think it's only around 50 or 60% of people who can claim the renters credit actually do. And I think it's 1 in 10 of people who can claim the mortgage interest relief who ultimately do. So I think the message would be to be aware of the reliefs available to you, and don't leave any money on the table.
No, very good advice. Thank you. And one final one there, just what do we realistically see happening tomorrow in the finance bill that will enhance any of these measures that came through last week?
Oh, it's hard. That's a hard question without a crystal ball.
Yeah.
I think there's always surprises, I suppose, in the finance bill, and the devil is in the detail. I suppose what I would be more concerned about is probably not what's going to be announced to further enhance, but what will be announced in the finance bill that might actually hinder or restrict some of the measures. So, on the one hand, we're very good as a nation at kind of announcing initiatives, but at the same time, then putting so many constrictions or restrictions and constraints on them that they become impossible to claim, or they become impossible for businesses to access. So, I suppose what I'd be really, really watching out for tomorrow is there any further kind of anti-avoidance, further restriction measures being imposed, and what does that do? Hopefully there isn't too many, because I think, in fairness, businesses are really trying to grapple with claiming these. But what we don't want is a restricted or further restricted R&D regime. We don't want a further restricted participation regime. We want them to work as intended. And if they work as intended, that's going to actually support business, which is actually what we want in the long run.
No, thank you very much for Colin. Both of you, we've come to the end of the questions that have been asked. A lot of very positive feedback there. So once again, thank you, Kerry. Thank you, Colin. Really do appreciate your time today. And thanks everybody for joining us.